I think timing is also very important in the sense when is it too early and when is it too late. Also, what is one raising the funds for? Right? I mean, we are a VC, so if you ask a VC, you may very often say, yeah, go to a VC to raise a fund, but very often it might be too early to go outside. So we always say that if you're strictly proof of concept, let's say it's more than a PowerPoint plan, and the product is just getting out there, it's in beta. Let's just say, for example, sometimes the best first round of funding is from family and friends or from the promoters themselves, because you're too early to raise funding, right? So let's just talk about timing. When is it too late? Sometimes it's too late where you may have a fantastic product, but you just find that some of the competitors which are not as ready have just gone out and managed to convince some of the investors to put in money, whereas you were sort of holding out, right? So I think timing is important. So coming back to timing. So what one needs to have in place is, I think, you start off with a business plan, right? Very simple. So when we make decisions, of course the team is the single most important driving the decision. But more than that, I think preparedness is very important, where the entrepreneur has to be prepared in terms of just having a very well thought through business plan for how much is one going to raise, how long will it last, and where will it take the company to. So one saying that I've heard, which is that we've heard, which is pretty very apt, is that investors invest in lines, not in a point, right? So we want to actually see how a company is moved from a point A to a point B to a point C. You want to track the life of the company. You don't invest in a snapshot, right? It's a journey. So if the entrepreneur says, okay, this is what I need money for, there should be a very good reason. It's not just for to just announce on a nice blog that you raise money, but this is the growth plan. For the growth plan, we need money. This is the kind of money that we need. The money is going to last us for about 12 to 18 months. In that 12 to 18 months, at the midway mark, we'll become cash flow profitable, and at that point, we'll need to raise more money. So a very well thought through plan. That doesn't have to be perfect, but this shows that the entrepreneurs thought about the usage of funds and intelligently, not just for just to announce, right? Not just for branding. One of the things that entrepreneurs will hear from VCs very often is that they want to invest in in companies that are going after fast-growing, large market spaces, right? They don't want to invest in niche companies, so they want to eventually get $100 million, $1 billion exit, right? So everybody, you've created value for everybody. So the basis of that is really a very well put together financial model, right? And let's break up the components of financial model, what should go into it. And there are some good sites that we can talk about later that actually break this up and list this out as a good resource for entrepreneurs. I think it starts with the market size, right? I mean, that's pretty logical that one wants to start with the market size, which is large. But more than that, I think what is a very important part of the financial model today that we're seeing is that there has to be what we'll call a P2P, right? Like a path to profitability at some point. I think the days are gone when a lot of money is just chasing cool startups where you can just grab a million, say a million, say about 100,000 users, and then you kind of figure out the monetization strategy later. So I think one of the things that good investors want to see is that you might actually be cash flow positive after your first round of funding, and you may not even need funding. If you look at cash flow analysis of P&L, you've got the revenue side and the cost side. So one is you can never control your revenues, but you can control your costs, right? One may hope for 1 million users, but you may only get 200,000. So on the cost side, we really like entrepreneurs who are, I would say, frugal, and it's just like in life, right? You don't live beyond your means. So for example, how do you control your burn? That you don't start off in a Ferrari, right? And you start off in a very, very limited way, a very well thought through way. So that I think the only thing you can control today is the cash that you have. So if I had to draw, there's a very interesting line. I'll just draw an imaginary line that somebody's raised, let's say 1 crore, and that line is going to go to 0, right? So what you can control, the only thing you can control is how long that cash is going to last. That's one. And how do you control your burn? at what point are you going to become cash flow positive, so that even after that, if you are spending more per month, you're also recovering in terms of revenues. So I think a very well thought through financial model is very, very important. But I would say again that we don't make our decisions just based on financial models, but they have to be there. You know, we've never backed a team that is a fantastic team, but hasn't thought through about how they want to monetize a problem at all. So I think a well thought through financial model and a business model with clear examples of how they're going to monetize the different revenue streams is important.